The United States is moving to bring stablecoin issuers under the same anti-money laundering framework as traditional banks. This comes after the Federal Deposit Insurance Corporation, FDIC, endorsed a new regulatory proposal that aligns stablecoin compliance with existing financial institution standards. The FDIC is preparing to update its AML rules to meet the evolving demands of the digital financial landscape. At the heart of this proposal is the extension of the Bank Secrecy Act, BSA, to cover stablecoin issuers that operate as subsidiaries of state banks under FD. These issuers will now be required to take on full responsibility for preventing financial crimes. The Genius Act has placed the FDIC as the primary regulatory authority for these rules, and it is pushing for similar actions from other federal banking regulators. The Office of the Comptroller of the Currency, OCC, has already released its own regulatory proposal in 2026, setting the stage for a broader regulatory landscape. The FDIC's strategy is: most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Clear, stablecoin issuers must now comply with the same measures that traditional banks follow to combat money laundering and terrorist financing. This includes mandatory reporting and adherence to sanctions programs outlined by FinCEN and OFAC. The impact of this proposal could be significant. Stablecoin issuers will need to implement robust compliance systems, which may increase operational costs and slow down market expansion. For investors and market participants, this signals a growing regulatory focus on digital assets. The FDIC's move is part of a broader effort to bring transparency and accountability to the stablecoin sector. As stablecoins are digital currencies pegged to reserve assets like the US dollar or euro, their widespread adoption has raised concerns about misuse in financial crimes. The FDIC's new rules aim to address these concerns by enforcing the same level of scrutiny as traditional financial institutions. The regulatory process is still unfolding, and the final shape of these rules could influence how stablecoins are issued and used. In the future, the FDIC's proposal is a step toward a more regulated environment for stablecoins, which could lead to increased institutional participation and investor confidence. However, the implementation of these rules may also introduce new challenges for smaller issuers who may struggle with compliance costs. The key question now is how these rules will be applied in practice and whether they will lead to a more secure and transparent stablecoin ecosystem. The FDIC's leadership in this area suggests most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Broader trend toward regulatory alignment across digital and traditional finance. As the proposal moves forward, stakeholders will be watching for signs of how these rules will be enforced and what impact they will have on the market. The next signal to watch is the finalization of the FDIC's updated AML rules and how they will be implemented across the banking sector. This development is part of a larger regulatory push that could shape the future of stablecoins in the United States.